All right, welcome to the channel. Welcome to yet another episode of my trading journey. So this part of the journey, I'll be covering how to trade options on Thinkorswim. And this option technique will be how to sell covered calls and how to exit the trade. But first, before I get into that, do understand I am not a financial advisor. Do your own due diligence before investing in the stock market or anything for that matter. That said, I'm gonna log on to Thinkorswim and we're gonna get into it. Let's go. All right, so we're all logged in to Schwab's Thinkorswim platform, and as I previously stated, we'll be using SMCI for the example. This is the covered call. You see here I have 200 shares. I paid $33.95 for each. They're currently going for $42.71. I also have 2 covered calls against the shares. Now, this covered call is a $65 call, which would expire June 20th. And I'm going to attempt to cash this out before the market closes. There's like 5 minutes or so left. I actually have 31 days left for this contract, but we don't have to necessarily wait that long. Now, why I'm closing this out is because I received $1.04 per contract. So that's $2.08. They're currently going for 40 cents. It says 405, but I'm using whole numbers. Now, this is how you would exit the trade. I got this highlighted. I'm going to click onto that. Oops, made a mistake. I was supposed to right click and I left clicked. Now, so here we are. See where it says create closing order? Scroll across. Now, it says buy 2 SMCI contracts at 42 cents. Click on that. And this is what pops up. It's, right here it says buy 2. Make sure everything's correct. That's a $65 call. The market's still open. Numbers fluctuating. I need to get out of this. Click confirm and send. And once you are sure that this is what you want to do, you hit send. And it's just filled. So I am out of that contract. Oh, and by the way, if you found value in the content, please like, share, and subscribe. And also, if you're ready to start your investing journey, there are 3 links in the description. One for Webull, one for Moomoo, one for Robinhood. Either one of those, you can get free stocks. Let's go. Let's get this money, y'all. Back to the video. Now, if I would like, I can do it again. Now, the reason why I sold that contract was simply, it went up about almost 50%. So I took profit. And this gives me the opportunity to do it again. So on this option chain, I'm gonna, let's see, we're gonna pick a strike price. This $47 strike price looks good to me. And we're gonna try and execute this. The market's going to close any second. Let's see. Bell rung. Might be too late. Let's see here. Confirm and send. Let's see if it'll go through. Nope, no hacks. Okay, that said, I didn't get it in. Well, anyway, I'll briefly explain what's going on here. You see the strike price that I chose, the $47 strike price? Why I elected for that one is because the delta is 0.16. Now, this is how you calculate your chances of probability. Subtracting that 16 from 100, that gives me a 84% chance of probability. Another reason why I chose this particular, well, not the strike price, I should say, why I chose the 23rd of May, because this is going to expire in about 3 days, and that cuts the theta short. Now, for those of you who may not know what I'm talking about, there are a component of options that are called Greeks, and there's 5 of them. One is Rho, RHO. Another one is Gamma. Then you have Vega. Then you have Theta and Delta. Now, Theta and Delta are the 2 main ones that I use. Hopefully that explains it a little bit better. So I felt that last contract that I bought back had a bit too much delta. Correction, not delta, had too much theta. Now, had I gotten this order in, the breakdown of this would have been, if SMCI goes to $47, then I would profit the difference between $33.95 and $47, plus the 0.31 times 2, which would have gave me 62 cents. But that's times 100 because we're dealing with option contracts. Now, also, I could have even went higher up with the strike price, but the higher up you go with your strike price, as you see here, the lower your premium becomes. So like you see here, if I'd have went with the 48.50, now this gives me a 90% chance of probability because the delta is 10. But see here, the bid is 18, the ask is 20. So if the market was open, I could have probably gotten filled somewhere between these two numbers, well, which would be 19. And I would have been selling 2 contracts. So just say if I would have got filled at 18, I would have, had I gotten filled, I would receive 36 cents. In fact, I don't even have to use the upcoming Friday's expiration date. I can go back to the chain and I can use the 30th. Now, if I use the 30th, I can go to $50. Now, this gives me an 83% chance of probability, and there's more premium. Now, if I went with that one, according to this is 51 cents, and I would have been selling 2 contracts, so that would be $1.02. And that pretty much sums up how to execute a covered call, and also helps you with choosing what strike price to sell at. So what did you think? Was the info helpful? If you found value in the content, please like, share, subscribe. Feel free to let me know what you thought in the comment section. Lastly, I'd like to take a second to thank all of you who watched the video. Thank you for sharing your time with me. And if you want to see more content, click up there. Until next video, love you all. Happy trading, be well, and peace.